Well, we made it to Friday end of week 10, so we are after today, two-thirds of the way there. And so it's on the downhill slope, although it's really weird because the downhill slope has a lot more bumps in it because you got the projects and exams and all the expectations. I don't know. Maybe we should do a better job as instructors about making it like a flatter path and making not end loading all of the projects at the end of the semester, but I don't know. I haven't figured out a good way to do that. Oh well, alas. We will talk about the exam here in just a little bit, but I do want to talk about the Code of Professional Conduct. I've alluded to this particular chapter many times, and I will say that for the most part, this is an easy, or not the chapter, but this topic. I've alluded to it. It's an easy topic. There is one massive exception to the ease of this topic, and it has to do with independence. So we're going to talk about the Code of Professional Conduct at a very basic level, and then we're going to talk about a lot of independence rules. And I will tell you that there will be one multiple choice question on the third exam, and it is likely to relate. I shouldn't even say likely. It is 100% going to relate to independence rules. So that should be the focus. And I think that this is relevant because independence rules are important, not just to people who are going into auditing and insurance, but independence is just a good philosophy to understand in just accounting rules in general. So that's going to be what we're going to talk about today. Let's go ahead and preface this by talking about what it is that the Code of Professional Conduct entails. So to start out, let me just tell you that this is going to have a lot of ethics-related philosophy topics that I'm sure you've heard many, many times before. If you've taken Capstone, you probably had a lot of discussion about this. This is one of those areas that Dr. Otero loves to talk about in the Capstone class. I mean, and for good reason. I think it's a very interesting topic area to discuss. If you ever had a philosophy course before, some of this is fairly familiar. We're not going to delve too deep in this. I don't think that it's required that you be an expert in philosophy or the topics in this area. Most of it is fairly intuitive, but if you do want to have a little backing on this, then you can review the professional judgment framework that we've talked about. There's also a lot of other areas, but that's kind of our gauge for proper problem solving and decision making in this course. It's going to be that thing that we talked about after the first exam. So let's go ahead and delve into the details. So with one notable exception, and I've already told you that exception, it's going to be the rules on independence. The CPA exam does not focus on the rules of conduct. So that's something I'm happy to know about because obviously I kind of use that as my litmus for this course. I say, hey, is it on the CPA exam? I better talk about it. I'm going to tell you some things that are not on the CPA exam because so you can just basically let those fly into your head and fly out the other ear, I guess. I'm not sure how you approach that, but it's something that it's probably need to be exposed to have some engagement with it, but it's not relevant that you memorize these things specifically. I do think you should be able to understand and define them. So we're going to talk about them, and the good news is they are fairly self-explanatory. All right. In fact, you're going to laugh when you see my explanations for some of these. I did not put a lot of effort into this. I've been using it now for going on 6-7 years, and I've not made any radical changes for it. So let's go ahead and talk about the rules of conduct. All right. So the rules of conduct are kind of the framework of the backbone of the Code of Professional Conduct. To talk about the rules that somebody who's performing assurance engagement should follow in due conduct of their engagement. So what are the rules of conduct? All right. So first of all, let me tell you right now, I'm going to list a whole bunch of rules for you. You do not need to memorize these rules. All right. You do not need to memorize them. Just be familiar with them. And like I said, if there's any that you just look at and say, I'm not sure what that means, that should be where you focus on. You should look at them and say, all right, what specifically does that mean? So there may be questions on them, but the simple truth is that if I ask a question, then they'll just be more about the context of the topics and anything. There is a good chance that if you take the final exam in this course, that I will ask questions on this because I think this is an area that I've traditionally included as additional content. But for the most part, you probably won't have to worry too much about these on the third exam. So integrity and objectivity. Does anybody heard these terms before? Integrity and objectivity? I hope so. Okay. I hope you act with integrity and you make decisions with objectivity. And basically it just means to be honest and impartial. And a lot of this goes back to what we talked about with respect to the professional judgment framework about how we approach particular problems, what the protocols are to approach them. Objectivity is a little bit harder to achieve, especially in this day and age. We are not good objective thinkers. We have a lot of biases. And that does affect integrity to some degree, because if we want something to be correct, then we may be willing to bend the rules to make it be correct. So we need to be completely, totally honest in our decision making, and we need to have the objective, make sure we have the objective truth in mind. Independence, no material or material indirect, no direct or material interest in clients. Now you notice that it's got 3 exclamation points. That's my symbol for, that's really important. I don't know if you've ever followed any of the online chess videos or ever seen any of those. Like whenever you see like a move that's really critical in chess, it's highlighted by an exclamation point. And if it's like a game-winning move, it's 2 exclamation points. This is 3. That's how important that is. Okay. This is a life-winning move, making sure that you have a good idea of what independence is, but we'll get into that here in just a second. All right, general standards are less than explanatory. Again, you don't need to memorize these, but you probably should have some understanding of what the general standards represent. So the 4 of them are professional competence, due professional care, planning and supervision, and sufficient relevant data. These are general standards that we're talking about in assurance engagement that should be followed to make sure that all the rules are that the evidence collected and the conduct of the engagement follows under generally accepted auditing standards or the assurance standards wherever necessary, because it's not necessarily restricted just to an audit. All right, compliance with standards. We're talking about audit. We're talking specifically making sure that you follow generally accepted auditing standards. If we're talking about an assurance engagement in general, it's whatever the standards are for that engagement area. And attestation engagements are statements on standards for attestation engagements, SAEs. If we're talking about assurance, we're talking about SSARS, statements on standards for accounting and review services. Keep in mind that it's whatever the rules are. I kind of shortcut this and kept it as audit, but it really depends on the engagement that we're talking about here with respect to the assurance engagements. Accounting principles is a little bit more straightforward. For most of our engagements, we're talking about GAAP, okay, general accepted accounting principles that we got to make sure we follow those rules, or probably more appropriately that our clients follow those rules. Keep in mind that this can change depending on the nature of the engagement. If we're doing an assurance engagement that's not on generally accepted accounting principles, then we must follow the rules of whatever the client is reporting on, whatever that reporting system is, whatever the framework is, okay, be it tax, cash basis, whatever it might be. All right, acts discreditable. This is pretty straightforward. Be good, okay? Don't do bad things. This is just good life advice, by the way, okay? But we're going to get into that because it's not nearly as obvious as you might think when we talk about acts discreditable, what that makes up. Contingent fees, generally speaking, those are not allowed. So a contingent fee is basically saying, hey, if I get you an unqualified opinion, then you pay me extra, all right? That's not the way things work, okay? That's going to be an undue influence. So you charge what you charge for the engagement, and that's it, okay? You don't get contingent fees in most situations. Commission and referral fees. These are also generally forbidden, okay? There are some exceptions that we're going to talk about, but for the most part, we don't get commissions or referral fees for the work that we do in assurance and auditing. Advertising and solicitation. This is obviously also wrong. That's not true, okay? That's not true. If advertising and solicitation was wrong, then Phil Mickelson could not have worn that KPMG hat for like 15 years when he was on the PGA Tour, which, by the way, I'm still really salty about that, okay? Because he started wearing that hat back in 2008. Do you know what else happened in 2008? The global financial crisis. A whole bunch of my friends were let go from KPMG. Meanwhile, Lefty's getting $10 million a year for wearing a dang hat, okay? So yeah, I'm a little bit unhappy about that. That $10 million could have gone to a much more productive purpose. Why do they need to advertise anyway? If you don't know what a public accounting firm is, you probably don't need one. All right. So yeah, I could rant about that for a little while, by the way. Yeah. So advertising and solicitation is usually fine as long as it's not misleading. You can't say that you can do things that you can't do. All right. That's basically there is to. Confidential client information. That probably gives up one key word, the word confidential. Confidential, obviously, okay? So confidential client information, don't share it with the outside world. If it's confidential, keep it confidential. That's all there's to it. Form of organization is named. You can't say that you're allowed to perform CPA services that you aren't, okay? Basically, this comes down to how the structure of your name comes up. There's very specific rules in this area. For example, if we deal with the big 4 accounting firms, do any of the big 4 accounting firms have the word CPA after their name? They do not, and there's a very specific reason for that. If you're going to have the word CPA after your name, anybody who signs off on an engagement has to be a CPA in order for that to work. We have a lot of people that work at Big Four accounting firms that are not CPAs, especially people in high decision-making positions. Now, if you go to like a local Kirksville office and you see, Barnes and Smith, CPA, I don't know why I said Smith, but that was the first name that came to mind. Barnes and Smith CPAs, that implies that both Barnes and Smith are CPAs, and as well as any partners who are in that firm, okay? They can only use that terminology if that actually applies to the members to the people of that firm. I should say the partners in the firm, anybody who's making a decision. That's it. That's basically all there's to it. So I guess we're time for the exam, right? We still got a little bit to talk about. So first of all, let's talk about some exceptions to the rule because there are a few of those. Okay. So notes on individual rules, contingent fees, these are generally not allowed. All right. And that's kind of be the default assumption. If we talk about contingent fees, that we generally do not allow those. However, they can be used in the case of CPA representation in legal proceedings or compilations for third parties. So what does that mean? If you are basically representing an organization, if you're basically asked to provide attestation in a legal proceeding, then you can provide a contingent fee based on the amount of work that you do. All right, that is allowed. Also for compilations for third parties, this is not somebody that you're engaging on a compilation for the main party. So your client is not the company that you're doing the compilation for. Your client is some other third party that's doing a compilation on the first party. So a good example of this would be a bank asks you to perform a compilation for Greek corner euros. You're doing the financial statements for Greek corner euros. They're the first party, but the third party is asking you to perform the compilation, and they're the ones who are going to finance that. So if it's somebody who's got an interest in the compilation, but is not directly affecting the compilation information, then you can charge contingent fees depending on the amount of work that's performed. So it's a little bit confusing, but fairly intuitive if you think about it. Commissions and referral fees. This is going to be permissible usually for tax and non-attest services. This is actually, it makes sense if you think about it, especially if we're talking about conflicts of interest with respect to auditing, especially on public clients. So tax, a lot of firms do not want to do tax and audit services because there may be a conflict of interest there. So that takes place. And then for non-attest services, there may not have the personnel in place to be able to perform that, or again, maybe conflict of interest may exist. So imagine that you're an auditor for a publicly traded company, and they say, we'd like you to actually set up our accounting information system as well. You're probably in a position that you could do that work, but you'd be auditing your own work if you did that. So they've offered you the service. You should be able to still make a trade off of that. You should be able to make some sort of benefit off of that. So you say, I can't do that, but I can recommend you somebody who does. And then you contact the party and say, I get a finding fee off of that. That seems kind of skeevy, but the simple truth is that if you are given that opportunity and then you become the representative for certain services, mostly tax and non-attest service, you can actually charge a commission or referral fee in that situation. All right. This one's an interesting one. This is about acts discreditable. So there's a lot of rules in this area, but interestingly enough, I've only ever seen one specific example that's ever been tested on in any version of the exam. So for those of you who are planning on sitting for the CPA exam, this is kind of a spoiler alert, okay? There is one particular scenario that always comes up. And I probably won't ask this on the exam, but I will talk about this. If you take a seminar on auditing with me in the graduate program, I will talk about this in that particular context. And the answer is that the situation is that failure to return client records following a client demand to do so. So you're on an audit engagement. You ask for a series of invoices because you're doing invoice testing, or you're doing we'll say accounts receivable testing. So you're looking at invoices, testing to make sure that the invoices are legitimate. You hold on to those invoices, and then you complete the engagement. And you still got those invoices on your person, and the client says, hey, we need those invoices back. They're part of our documentation. And you just ignore it because you're just kind of like, hey, this engagement's over. I don't care anymore. Okay. That is one of the examples of acts discreditable. In fact, that is the primary example of acts discreditable, is when they ask you, give us our documents back, and you say no, or technically more speaking, you just failed to do it. Okay. That is basically one of the areas that they focus on. I think the reason why that's such an emphasis and area of focus on the CPA exam is simply because that's not intuitively considered to be an acts discreditable. Like if you go out and start a bar fight as a CPA, that makes perfect sense why that would be an acts discreditable. But if you just fail to give back records, it doesn't seem like that you're doing anything wrong. But this is a big area of emphasis that they say is a big problem. It's a big no-no. So that's something you should be aware of. If you see this question come up, or this topic come up, this is the main area of emphasis for acts discreditable. Now, I'm saying there are other ways you can't discredit yourself. If you probably go running around naked and in a parking lot of the client, that probably would be an access creditable as well. But I will tell you that's not on the CPA exam. It probably shouldn't have been in this class either. But yeah, I wanted to put that in context. I want to put that in context. There's also a big list of professional threats and safeguards. This is part of the AICPA for conceptual framework for independence. These are relatively self-explanatory. I don't think it's worth taking time up to talk about it, simply because it's not a heavy area of emphasis for any of the certification exams, and it's not something that you'll have to worry about making sure you're in line with if you go into public practice, simply because there will be a lot of focus on this. They'll tell you specifically what it is you need to do in this area. That being said, we need to talk about independence, because this is an important one. This is kind of the crux of our profession, because it doesn't make any sense that if we're not independent, that we can be an independent representative of the client. Because we talked about this back in our very first lecture. We said, what is the role of the auditor? The role of the auditor is to serve as a mediator between the client and between for the principals and the agents. But both of them are representative of the client. So the owners of the organization, the people who run the organization. If we have an existing relationship with either, we can't really be a mediator. We can't be a good representative. So what does it mean to be independent? We haven't really gone into detail. Some of them are pretty obvious. Some of them are less obvious. So independence rule is a member of public practice shall be independent in the performance of professional services. And that's kind of like, well, duh. Okay, that makes sense. So this applies to all forms of attestation services, which would include audits, and covered members must be independent. So anything that's an attestation service or higher, which would be an audit, does apply to. This also applies to assurance, reviews and assurance services. We talked a little bit about what that represents. And basically the rules, the people who have to follow these rules are considered to be covered members. Now, I do want to make a note of this because this is very confusing, all right? The list we're going to look at is going to be a list of who would be construed as a covered member. That is not an exclusive list of everybody who must follow the rules. We're going to talk about a little bit later saying, okay, these are individuals who are not technically covered members, but still have to follow the rules of covered members. And just as a spoiler, these are going to be family members of covered members. Okay, so that's why that'd be the case. So when I use the term covered members, we're talking about those exclusive individuals or entities that are considered to be under this umbrella. And then we're going to talk about anybody who has a relationship with the covered members who also has to follow these rules. So if you have a relationship, at a close enough relationship, you also have to follow these rules and these guidelines. So who are covered members? Some of these are pretty obvious, okay? An individual on the attest engagement team, all right? So you're an intern from Truman State and you are assigned to an audit team because you're doing an internship in auditing. And so you go and you're auditing, let's say Amazon, okay? I don't know how likely that is because I think they're based on the East or the West Coast, but you audit Amazon, you cannot have any stock in Amazon. You may say, Dr. Barnes, I'm just an intern. It's like, it doesn't matter. You are a representative that's on the engagement team. You have to be independent from the client, okay? You can't be in any decision-making capacity. Also, anybody who's an individual, part of the organization that's in a position to influence the attest engagement. So this is people who are not necessarily on the engagement team, but can actually influence the nature of the engagement. Usually these are going to be partners with close relationships or close ties to the client, okay? A partner provides more than 10 hours of non-attest services to the attest client within fiscal year. So let's say we provide additional services that are not under attest, the attest engagement umbrella, all of those different things that represent attestation. Could you be a partner on that situation? The answer is up until a point. If you provide more than 10 hours of non-attest services, then you're considered to be a covered member. Now, just to clarify, these first two, the first one is talking about people who provide specifically attest services, which would include an audit, okay? This is referring to somebody who's providing services that do not fall under those same rules. So like tax services would be a good example. They provide tax or advising services that are not attestation services. As long as it doesn't exceed 10 hours, they're fine. But once they hit that 10-hour threshold, they have to be classified as covered members and by definition have to be independent. This one's a really confusing one, so make a note of this one. A partner in the office in which the lead attest engagement partner primarily practices in connection to the attest engagement, okay? So what does this mean? Let's say we have a client, let's say Bear, okay? They're a good St. Louis client. Bear is in St. Louis area, okay? And the primary attest engagement or the audit, we'll say audit because I make it clear. Primary audit engagement team is going to be in the St. Louis area. So the lead partner is in the St. Louis office. The lead partner on the bear engagement is in the St. Louis office. All of the partners in the St. Louis office also have to be independent of bear. Okay. Now, does that mean every single partner in the firm needs to be independent? No, the ones in the Kansas City office, the ones in the Memphis office, the ones in the New York office, the ones in Chicago office, they're fine not to be independent from this client, okay? But the ones in the engagement, the lead engagement partner's office, all need to be independent. Okay. The firm itself, including the firm's employee benefit plan. So this is going to be an opportunity. So you've heard me talk about retirement and investing. We talked about this at very kind of a very basic level in other courses. But you're probably going to go into public accounting and you say, oh, 401k, that's a great idea. And it is. It is a very good idea. But you should be aware that these structured plans these plans are very closely structured and very closely reviewed to make sure that any investment plan that you have that's held by the organization that you're working for, they do not have investments in their clients. So, say, but a good example, when I worked for KPMG, Merrill Lynch was our benefits provider. They handled our plans. They had to make sure that there were no investments through the Merrill Lynch investment plan that had relationships with KPMG clients. So even though I would have directly invested anyway, the clients that I was working on, I could not have any investment, whether through my plan or to directly through my own work, through my own investing. So that's something the firm itself has to be independent completely, and that includes the benefit plan. And then finally, an entity whose operating, financial, and other accounting policies can be controlled by any of the individuals or entities described above. This is kind of more of an umbrella saying, okay, if there's an entity who can be controlled by a covered member, they also are considered to be covered members as well. This doesn't come up very often, but it does come up. All right. So what are the prohibited interests that must be dealt with? So if you remember, we talked about independence back in the rules. I said no direct or material interests in the client. Specifically, no direct interest and no material indirect interests in the client. So a direct interest is pretty straightforward. Stock ownership in the client. This includes partnerships and trusts, okay? So you cannot have any ownership of the client to speak of. Now, material indirect is a little bit more subtle, okay? It's a little bit more subtle. Stock ownership of a client, stock ownership, I can't talk today. Stock ownership of a client subsidiary, or mutual fund investments in the client, or even financial interest of close family members, okay? Now, there are some rules, some exceptions to this, okay? Some examples of this, certain types of bank loans are considered to be okay, particularly ones that are called grandfathered bank loans. So let's say that you're you've got a car loan with Bank of Kirksville down the street, and then all of a sudden you go work for the firm that does the audit for Bank of Kirksville. Are you going to have to pay off your loan in response to that because you're not independent? The answer is no. If it's an existing car loan, usually those considered to be provisions that are okay, that are grandfathered in, particularly if it's a collateralized loan, which means that if you fail to pay off your loan, they're going to take your vehicle. There's also a few rules with respect to credit cards. Credit cards with small balances are considered to be okay. So if you you did the audit for Capital One, that's a good example. They're a credit card company. So you did the audit for Capital One, they would look at your credit card balance and say, all right, if it's less than $10,000, then that's fine. You're not considered to be impair independence. That's really hard to say, impair independence. But if you have a credit card line of over $10,000, then you would have to divest that credit card. You'd have to get rid of it, cancel it, whatever the word is. All right. With respect to business relationships, independence is imperative. The CPA performs managerial or significant activities for an organization during the time period covered by the attest engagements. Okay, so this is pretty obvious. We've talked about this already, but let's say that we're a CPA firm and we're hired to do some sort of consulting and development service for us. So basically put together a new AIS system for the organization. We already talked about why that's problematic. If you do work and then you eventually perform some sort of attest service on that work, you're effectively testing your own work, which we've already talked about the flaw with that. If I let everybody test grade their own exams, I'd have a lot of 60s on the exams, okay? Actually, Truman students tend to be pretty honest. You tend to be a lot more rigorous on yourself than I am. So maybe that's an opportunity for me. I don't know. Get away from grading exams, have the students grade their own exams. I'm not willing to take that path. Let's be honest. there may be a lot of erasing and saying, I meant to answer this, Dr. Barnes. Yeah, that would be the case. So the same logic holds in case. Now, there are kind of some caveats to that. General relationships and trade associations like country clubs or honorary trustees of the clients like charities, they're not considered to be pair independents. So can you be in the same country club or be on the same charity as the client? And the answer is it depends. Okay. It depends on the financial role that you play with those organizations. If you don't have any financial interest, that's perfectly fine. Okay. If you're put in a position of financial trust, that's when the scrutiny starts. So, say, for example, they say, we need a treasurer for our charity. Then, if you're on there with another client, then that's considered to be a relationship between the client that might impair your independence. So, that's considered to be concerning. All right, this is the one that gets a little bit dicey. Here's the next step, okay? So remember I said what the covered members are? By the way, those covered member rules, very important. Make sure that you review these rules before the next exam, okay? It's just a good series of notes. Make sure you're familiar with those. Also, it's important to note that there are existing relationships where people who are not covered members still have to follow the covered member rules. And these are family relationships. So all immediate members of a covered family members of a covered member are subject to the same independence requirements. Okay. So what would be an example of an immediate family member? Easy, obvious one. It's going to be your spouse or your partner. Okay. And they need immediate dependence. So we're talking about, I'm gonna have to use an example other than me, but if we're talking about my brother, for example, let's say my brother is an auditor. He's not, he would hate to be called that. Okay. But he's an auditor and he's doing the audit for a company that his wife is the CFO for. That would be a problem. Okay. Because there's a very big barrier there. Does that mean she needs to follow the rules of, sorry, does that mean she's a covered member? The answer is no, but she has to follow the same rules as a covered member. Okay. She has to be independent. So that relationship would be problematic. It could be much something more simple than that. Let's say that he's doing the audit. And it's not that the wife is an employee of the organization, but she has a very large stock interest, a material stock interest. That would be considered a violation simply because they are married. Okay. And she's got a material direct interest or material interest. Direct, it doesn't really matter if it's material, a direct interest in the client. So because of her relationship with my brother, she would have to follow the same rules that he have. Okay. By the way, neither of them are auditors or even close to accountants, though my sister-in-law does enjoy Excel from time to time. So a little bit of accountant. All right, so that's true for spouses of partners or dependents. So usually we're talking about dependent children, though it can be anybody classified as dependent for tax purposes. All right, next one is going to be independence may be impaired for covered members with close relatives who have material financial interest in the client or significant influence in the client. So when you talk about close relatives, that's a little bit more broad. That's going to be parents, siblings, and non-dependent children. Parents, siblings, and non-dependent children. Now, the rules are a little bit more lax for that group. Basically, that says, look, you don't have to follow the covered member rules unless you have a material financial interest in the client or you have significant influence of the client. So going back to that example that I was talking about before, my brother's wife, he's an auditor on a client. She can't have any stock ownership in the client whatsoever. It's a direct ownership interest. It doesn't even matter if it's material. In this situation, if we're talking about my brother, though, so talking about siblings is going to be a close family member. I could still own stock in the client as long as it's not a material amount, or I could have some sort of influence on the client as long as it's not construed as significant influence, like I'm in a position of authority to change client policies. And so since I'm in a sibling position, my rules are a little bit more lax. Okay, so that would be an example of that. So just keep in mind, it's important to note that there are relationships that would be considered to be covered members. They are a little bit confusing. The most important thing to remember is that our immediate family, which again is going to be spouse and partner and dependent children, they basically have to follow the exact same rules as covered members. Okay. If we're talking about close relatives, they don't have to follow the exact same rules unless they have some sort of significant relationship with the client, whether that be a material interest or that's be significant influence. There's a few others that I want to talk a little bit about, okay? So these are kind of a few other niche rules that are really important because they do come up from time to time. So past due engagement fees, we're talking about engagement fees for over a year old, all right? So remember back in 303, I say that a lot. I was making a joke to I don't remember who it was. I think it was Dr. Otero. I was saying my auditing students are probably getting really, really sick of me talking about financial accounting all the time because it's not a financial accounting class. I say, but it does have financial accounting prerequisites. And this is the reason, because I refer back to the financial accounting rules all the time. But remember back from 303, if you have a short or you have a current liability that is over a year old, what happens to that current liability? Does it get to be recognized as still be recognized as a current liability? So example, account payable that has not been paid off for a year. Does that have to be reclassified? It does. Under the rules, it has to be classified as a note. Okay. What do we know about notes? What do they have associated with it? It's up here on the slide, by the way. Implicit interest. Okay. Implicit interest. Doesn't matter if any actual interest exists or not. We do have to discount it with implicit interest. Okay. So if there's interest on a particular item, that means that you have a credit instrument in the client, which represents a form of ownership. Can you audit something or can you provide assurance services over something that you own? The answer is no. Okay. So if you have past due fees over a year old, you are automatically constrained from doing ACCT services for the client. Past due fees, I shouldn't say just audit fees, but engagement fees. It's effectively considered to be a loan to the client. Also, if you have actual or threatened litigation, if it's commenced or it's probable that it'll commence by the client of CPA, then we consider that to be an impairment of independence. Again, that makes kind of sense, all right? Say that you go and says, this audit was garbage. I can't believe you issued a going concern opinion. We are going to sue you for everything you're worth. See you in about 3 months so we can prepare for the next year, okay? That probably does not a conversation that you're going to have. You're not going to have a conversation with the client where they're going to say, we still want you to do the audit, but we're going to sue you for all you're worth. At the point where they start threatening litigation, you should probably sever all ties. It's a good idea. We could actually ask Professor Temple to come in and see what his thoughts are on the matter. He'd probably say the same thing, although he probably has not dealt with auditors. So who knows? Who knows? I don't know what his background is on auditors. He's very quiet about his past, which makes me suspect that he's got a shady background. He's got a shady background. He was an auditor. Well, he was an accountant, but yeah, he did auditing. Okay. And he left it because he didn't like it. So yeah. All right. Well, there we go. There we go. I don't trust anybody who leaves auditing to become a lawyer. I mean, that's just like a strict downgrade. Okay. Strict shiftward down. All right. All right. So that does it. That's going to be all that we're going to talk about with respect to this.